Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Podcast. And my name is Bert Salazar, and I'm going to be your host, as I am every single week. Today is episode 148. And the title to this episode, which is a continuation of the last episode in which we talked about the 401k and qualified plans as they being a time bomb. But this is going to be a two-part series response. So today's episode is called How to Defuse the 401k Time Bomb Part 1. And then I'll do Part 2 next week. And I'm going to be able to give you a lot of the good ideas that are going to help you offset the tax liabilities that most of us are having to face now and or the future, in the future when it comes to your qualified plan. So always remember that I am a published author. You can find my book on Amazon, and the name of the book is Retirement Paradigms, Managing Retirement Risk in the 21st Century. So, you may want to pick up my book, or you can download it, you can buy the hard copy, and it's going to talk to you about, what are the challenges that all of us are going to have to face in retirement, and how do we mitigate those challenges from a business and from a risk management perspective. So it's about 186 pages, so it's full of information. So you would be helping the online community by purchasing the book, and then obviously you're going to be helping yourself and your family along those lines. So last week when we had our conversation regarding the 401k time bomb, we spoke about a lot of different things, and you can go back and pull up that episode, which would be 147, and we talked about the taxation and the impact of taxation in the future on qualified plan assets, where the money has been growing on a tax deferred basis for so many years, and then the impact on your Social Security benefits and the taxation of Social Security benefits and even your Medicare premiums. But along those lines, what I'd like to do is I want to start, talking to you a little bit about how to defuse the 401k time bomb. And there's a number of ways that you can do it. You can do it through a Roth 401k. You can do it through a Roth IRA. Our conversation today will apply to both, but primarily to Roth IRAs. You can do it through municipal bonds up to a certain extent, because municipal bonds do have a negative impact on your qualified plans, on your Social Security taxation. But then again, we're also in the next episode, we're going to talk about, using life insurance as a supplemental retirement plan, and the incredible features and benefits of using those types of contracts in order to minimize your tax liability in the future when it comes to taxation. Now, one of the things that we have all had to deal with is that Congress just went ahead and passed that $1.9 trillion COVID, which is a lot more than that, because it's got so many different little pork rinds in there that, it's not even funny. And now they're looking to do some infrastructure. They're probably infrastructure, so they're going to probably add another, $2 trillion on that exercise. So by the time it's all said and done, we're going to be well north of $30 trillion in our national debt, and no way to pay for it unless we start raising taxes. And that's another thing that now the Biden administration is going to start looking into, how to raise taxes. And please don't be fooled, and this has nothing to do with politics. Because I'm a contrarian from that perspective. This is all about, taxes and business. Everybody's going to have to pay the piper, because there are not enough wealthy people, even if you tax them at 100%, to be able to pay for the liability that we have in this country. So you better be ready. So now I'm going to be sharing with you, what are things that you can do in order to defuse the 401k time bomb, which is about to explode on all of us. So let's talk a little bit about Roth IRAs. Now, we all know that Roth IRAs have taxable after-tax contributions, tax-deferred growth, and then tax-free distribution. So the money that you put in is after tax, so you have already paid taxes on your contributions. You can't take a deduction for that. The money will grow tax-deferred inside of a Roth account, and then your distributions will be tax-free. Now, there are a number of booby traps. There are actually a lot of them inside of all these qualified plans that most Americans are not privy to. But through this podcast today, I'm going to bring a few of them to the forefront for you when it comes to Roth IRAs. You have to be aware of the 3 5-year rules for Roth IRA distributions, and this is, one of the ones that I get often asked about by my clients and by my online community. So I'm going to share this with you. Now, the first 5-year rule states that you must wait 5 years from the year of contribution to withdraw your interest in the account on a tax-free basis. So let me repeat that again. The first 5-year rule states that you must wait 5 years from the year of contribution to withdraw the interest tax-free. Now, what's interesting about all this is that the 5 years starts on the first day of the year that you contribute. So if you contribute to a Roth IRA, let's say January 1, you contributed, let's say January 1 of 2021, that's the start of the start of the clock for the 5-year rule. Now, what if you contribute to your Roth IRA, you made the contribution in November of 2021? Well, the clock doesn't start in November of 2021. The clock actually started on January 1 of 2021. So if you delay the contributions to a Roth IRA throughout the year, you will actually benefit as well, because it'll go back to January 1. So you actually have less than 5 years for you to hold the money, because of the fact that you put the money in November of 2021 as opposed to January of 2021, which is something that most Americans don't know about. Now, the contributions, if you want to pull out the contributions, even if you're not in that 5-year window, the contributions, you can always pull them out tax-free because you have already paid taxes on those contributions. And actually, this rule supersedes the 59.5 rule. So if you have to take money out and you're prior to the age of 59.5, you can always take your principal out without having to pay taxes, because you have already paid the taxes on that. Now, the clock, and this is another very important issue, the clock starts with the first Roth IRA you create. So let's say that you created a Roth IRA in 2010, you created another one in 2014, you created another one in 2017, and then you are creating one now in 2021. Although you have created a number of Roth IRAs throughout the last 10 years, the one that counts is the first one that you did in 2020. So you have already satisfied the 5-year window for all of your Roth IRAs because of the fact that you opened your first Roth IRA in 2020. So that's a very, very important issue for all of you to keep an eye on when it comes to understanding the rules of Roth IRAs. So that's pretty much the first one of the 5-year rule. The fact that you have to have the account open for at least 5 years if you want to take the interest and the growth of that Roth IRA on a tax-free as well. Now, the second 5-year rule applies to Roth conversions. Remember, this is not a Roth contribution. It would be a Roth conversion. So what do I mean by that? Well, let's say that you have an IRA, you have a traditional IRA, and you have $100,000 in that traditional IRA. And in 2021, let's say you want to convert out of that traditional IRA, you want to convert $25,000 and convert it to a Roth. Now, you know that when you do that conversion, you're going to have to pay taxes in the year of that conversion. So those $25,000 that you are converting in 2021 would now become a taxable event to you in 2021, so at the end of 2021, you will be receiving a 1099 from the financial institution. It will be a 1099-R, which will be based on the $25,000 that you converted from the traditional IRA to the Roth IRA. So the second 5-year rule only applies to Roth conversions, and this is how it works. Now, bear in mind that the idea of this rule is to prevent people to use Roth conversions to get penalty-free access to traditional retirement accounts. This rule applies to each conversion and starts the first day of the year in which the conversion is made. So it's very similar, at least on that portion, to the Roth IRA contribution. So even if you made a Roth conversion in July of 2021, the 5-year clock will start as of January 1 of 2021. Now, the challenging part of this is that if you made a $25,000 Roth conversion in 2021 out of the $100,000 that you have in the traditional IRA, and then in 2022 you decide to do another Roth conversion for another $25,000, then that 2022 Roth conversion will have its own 5-year clock as well. So it's not similar to the Roth IRA contributions where you go back to the original Roth IRA that you created at that point in time. Roth conversions were totally different. So remember that the rule applies to each conversion and starts the first day of the year in which the conversion is made. Now, this rule also applies not only to pre-tax, but also after-tax contributions as well. So, one of the things that I discuss with my clients, because remember, in order for you to make Roth IRA contributions, if you go above and beyond the income threshold, you may not be able to make a contribution to a Roth. Now, as far as a Roth conversion, those rules were done away with, so I don't care how much money you make. You can do a Roth conversion at any point in time. But for you to qualify for a Roth IRA contribution, whether you're single or you're married, you have to be underneath the thresholds from an income standpoint for you to convert. Now, one of the recommendations I make to my clients is to do what is known as a backdoor or a mega backdoor Roth contribution, which basically what you're doing is you're making a non-deductible contribution to an IRA, and then immediately thereafter, you take that non-deductible contribution to an IRA and you convert it to a Roth. Because of the fact that you made a non-deductible contribution to an IRA, although it's in the IRA world, it is a non-deductible or an after-tax contribution. So now you have the ability to max out your contributions to a backdoor IRA where you're using the IRA rules as a stepping stone to get you to the Roth IRA. So this is a little bit more complex than I'm explaining to you now, but this is an opportunity for many of you that have incomes in above and beyond the threshold for your Roth IRA contribution guidelines, and you're still able to make a contribution to an IRA and then do a Roth conversion with those monies, and then that money will continue to grow tax-free for the rest of your life. So that would be the second 5-year rule, which applies to Roth conversions. Now, there's another, the third rule, and this is the last rule. The third 5-year rule is on inherited IRAs. Let's say someone passes away and you happen to be the beneficiary on that IRA. It is now called an inherited IRA. Now, if you inherit an IRA from someone other than your spouse, because if it happens to be your spouse, then you as a beneficiary and as the surviving beneficiary, you have all kinds of flexibility. But if you inherit an IRA from someone other than your spouse, then you can pretty much spread the distribution over a 10-year period. Another option is to take lump sum distributions for up to 5 years, but you have to make certain that the account must be totally depleted no later than the 5th year or the 10th year for that matter. By the way, even with the 10-year conversion for non-spousal beneficiaries of inherited IRAs, you're not obligated to take a certain percentage every year. You can pick and choose a year so you want to, as long as by year 10 or as long as by year 5, the account is totally depleted and there's no more money in the account. And you want to make certain that that is the case. Because now you may say, well, Bert, what if that's not the case? What if I still have money left in the account at the end of the 10th year, at the end of the 5th year? Then obviously you're going to get a knock on your financial door from the IRS, and they're going to charge you a 50% penalty. Yes, you heard me right, a 50% penalty for failure to deplete the account within the allowable time that you had chosen at the time of distribution. Now, inherited IRAs are also subject to the 5-year contribution rule as well. So if the person who passed away and opened that original IRA, which after passing away now became an inherited IRA, and you're not a spouse, but you happen to be a beneficiary, if the account was open within a 5-year period, then you have to wait the 5-year rule, because otherwise taxes would be imposed on the growth of that money as well. Now, another key question that I often get from clients and my online community is, what are the penalties for 5-year rule violations? And they could be very hefty. So, for accounting and penalty purposes, it is FIFO, first in, first out. So if you have enough contributions, you may be able to avoid the penalty altogether. Now, that would be for traditional IRA contributions from that perspective. So if it's a Roth IRA contribution that you inherited, then it is FIFO. So that means if you're taking $25,000 and there was a $50,000 basis in the Roth IRA, meaning that $50,000 has already paid taxes on, then even if you're not at the 5-year rule, you can take that the 5-year mark. You can take that distribution FIFO, because the first monies coming out for distribution purposes would be from the initial contributions, which have already been taxed. That's why under accounting purposes they call it FIFO, first in and first out. So that's important to note. Now, if you happen to inherit and be the beneficiary, non-spousal beneficiary of an inherited Roth conversion, then it is the other way around. It is LIFO, which means last in, first out. So therefore, the 10% penalty will apply to the money that you converted over, unless you happen to be over the age of 59 and a half, or, if the penalty, if the account was done through a conversion by the original owner prior to passing away. So, some of these rules are quite complex, so make certain that if you have a situation like that you have a conversation with your tax preparer, your accountant, or a financial advisor that specializes in retirement distribution planning, because at the end of the day, although there are a number of booby traps and there are certain limitations when it comes to Roth IRAs and Roth 401ks, it is a great way to defuse your 401k time bomb, because if taxes are going to be much, much greater in the future than they are today, I would rather pay the tax today than to pay it in the future, because at the end of the day, if you wait till the future, you really have no idea how much money you have in your qualified plans, your traditional qualified plans, or your, that would mean your traditional IRAs, your 401ks, your 403bs, any type of traditional pre-tax account. Because the IRS will make that determination at some point in time in the future. You see, the IRS is the general partner to all of your retirement accounts. So they're going to govern your retirement accounts. Now, one of the beautiful things that you can have from a portfolio of Roth IRAs is that there's no required minimum distribution. So you can segment your retirement distribution planning by utilizing pre-tax contributions up to a certain level in order to offset any tax liabilities through standard and itemized deduction offsets. But most important, a Roth IRA, as opposed to your traditional IRAs, do not have a required minimum distribution. Now, for most of us now, unless you turn 70 and a half in 2019, now the required minimum distribution must start at age 72. And again, if you don't start those distributions, there will be a 50% excise tax penalty plus taxes on the amount of money that you should have taken out, but you didn't, or you decided not to. So you have to be very, very careful of all of these rules. Now, for IRA contributions, in 2021, the maximum that you contribute, if you're under the age of 50, will be $6,000. If you're over the age of 60, will be $7,000. So they'll give you $1,000 as an additional catch-up contribution to a Roth. For many Americans, that's more than enough, but for others, it's not enough. And that's where other issues like 7702 plans, which are your cash value life insurance plans that are primarily designed as what I normally called, and there's no legal term for this, but I normally call it a Roth IRA on steroids. It's not a Roth IRA, but it can be made to look alike or have certain similarities to a Roth IRA. But you're using a life insurance contract in order to execute that. So I'll discuss more about that next week when I'll use the other option on how to diffuse the 401k or your qualified plans time bombs as you may see coming down the pike. I can tell you, having been in this industry and having been in the accounting business for many, many years, taxes are more than likely going to have to double, or our country's going to go bankrupt. And this is now why you're seeing a lot of people, taking a lot of their money and putting them into other types of currencies. And we'll discuss that in a couple of weeks. I'm going to talk to you a little bit about, some of the things that I am doing and some of the things that other people that I know are doing regarding currencies and devaluation and decentralized currency and so forth, because every time the U.S. government is printing dollars, your dollars and my dollars, for that matter, are worth less and less every single day. So you have to be able to understand how the rules of engagement work in order for you to maximize your retirement income and that of your family while minimizing all of your tax liabilities. So for those of you that may want to pick my brain about this or anything else, please feel free to reach out. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, BertSalazar.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks so much for giving me a few minutes of your time today, and I'll talk to you soon. Take care. Bye-bye.